Welcome to the Hughes Optioneering Weekly Workshop, where we scientifically engineer trades for greater profit potential. This is the disclaimer slide. You can pause to read it. We're going to move on. Today we're going to look at CCJ, or Cameco Corporation. CCJ is one of the world's largest uranium producers. Here's the barchart.com technical opinion rating for CCJ. The bar chart rating is an 88% buy, with an average short-term outlook on maintaining the current direction. Long-term indicators fully support a continuation of the trend. According to Prime Trade Select rules, the stock is in a bull trend on a monthly basis if the stock price is above the 10-period or 10-month simple moving average. The monthly chart shows that CCJ is well above the moving average line, so the monthly trend in CCJ is up. Now we're going to look at the daily chart. The stock is in a bull trend on a daily basis if the 50-period or 50-day exponential moving average is above the 100-day exponential moving average. The blue line is the 50-day EMA line, and the green line is the 100-day EMA line. The blue line has been above the green line since the chart started, so the daily trend in CCJ is up. Next, we're going to look at a daily chart that displays the Keltner channel. As a rule, we don't want to buy calls if the stock price is above the upper Keltner channel line. Anywhere inside the Keltner channel or even below the Keltner channel is fine. CCJ is near the midline of the Keltner channel, so CCJ is inside the buy zone. Since the trend is up, we want to buy a call. CCG has plenty of option chains to choose from. We're going to use the December 15 option chain. Right now, the December 15 options have 54 days to expiration. Here's the CCJ option chain for December 15. CCJ closed at 38.19 on Friday. That means any calls on the list from 20 to 38 are in the money. Let's take a look at the profit potential for purchasing the 38 strike call, which is the closest strike to the current price of the stock. The bid-ask spread for the 38 call is 3 to 310. We try to enter at the midpoint, so we'll use 305 as the buy price. Our call option calculator shows the profit potential for this call based on CCJ price changes at option expiration from flat to a 12.5% increase in price. We can see that if the CCJ stock price is flat at 38.19 at option expiration, the 38 call will lose 93.8% of its value. Ouch. This is an unacceptable risk. That kind of loss can wipe out our trading account in a hurry. We developed what we call the 1% rule to help us avoid this kind of risk. The 1% rule says to limit the time value portion of the option we buy to 1% of the stock price. That means the stock only has to move up 1% for the call option we purchase to break even and start profiting. Now let's take a look at buying the 32 strike call to see if it qualifies for the 1% rule. Here's the call option calculator picture for the 32 call. According to the 1% rule, we want the call to at least break even if the stock price is up 1%. The calculator picture shows that if the CCJ stock price is up 1%, the 32 call will lose 7.4% of its value. We want that to be break even or better, so the 32 call does not meet our requirements. Let's see if the 27 call will work. The bid-ask spread for the 27 call is 11.20 to 11.80. We try to enter at the midpoint, so we'll use 11.50 as the buy price. The 27 call works. If the CCJ stock price is up 1%, the 27 call will make a 0.6% or $7 profit. That's better than break even, so the 27 call is the one we'll buy. The call option purchase calculator also shows that if the CCJ stock price increases by 2.5%, the 27 call will make a 5.6% or $64 profit. If the CCJ stock price increases by 5%, the 27 call will make a 13.9% or $160 profit. If the CCJ stock price increases by 7.5%, the 27 call will make a 22.2% or $255 profit. The 10% and 12.5% numbers are also displayed. You can see that the profits get better and better. And notice that if the CCJ stock price does not make the expected move up and remains flat at expiration, the 27 call would only lose minus 2.7% or minus $31 compared to the 93.8% loss or the $286 loss for the 38 strike call that we looked at earlier. Now we want to review a call option debit spread, aka a vertical call spread. For this spread, we want to buy to open the CCJ December 15 32 strike call and sell to open the CCJ December 15 37 strike call. We're going to base our entry prices on the midpoint between the bid and ask prices. That means we'll buy the 32 call for $7.10, sell the 37 call for $3.55. $7.10 minus $3.55 equals $3.55. So the entry price or debit cost for the spread is $355. The call option spread analysis calculated picture shows that the spread will make a 40.8% or $145 profit if the CCJ stock price declines by 2.5%, remains flat, or increases in price when the options expire. If CCJ is down 7.5% at expiration, the trade will lose minus 6.3% or minus $22. Creating the debit spread will allow us to collect a $355 cash credit to our brokerage account for the sale of the 37 call. As we said on the previous slide, this reduces the cost of entering the spread to $355. Here's a note regarding earnings reports. The next CCJ earnings report is scheduled for Halloween, October 31st. Let's review the trades one more time. The first trade was a call purchase, said to buy to open the CCJ December 15 27 strike call for $5.90. We also reviewed the spread. The spread said to buy to open the CCJ December 15 32 strike call and sell to open a CCJ December 15 expiration 37 strike call at a debit of $3.55. That's it for this week's Optioneering Workshop. Thank you for joining us. We look forward to seeing you again next week.